Okay, hello, this is Professor Hazara again, and this is the fourth video on valuation of levered firms. I would call it a rough theory of valuation of levered firms. But anyway, so the first thing we had done is we had calculated our free cash flow to the firm, and then we've calculated an unlevered return on equity. And then we using the adjusted present value approach, which basically takes the value of an unlevered firm as the tax shield, and that gives you the value of a levered firm, and then you make some adjustments for non-operating assets and all that, and pull out the debt. We got $74.89, assuming no growth. So I like this approach sometimes because at the end we'll see sort of the value of growth. Okay, now we're going to get the same number using the weighted average cost of capital approach. And in this approach, it's exactly what it says. It's the weighted average cost of capital. So we're going to use this weight to weight the cost of debt. We're going to use this weight to weight the cost of equity. And then we will come up with a weighted average cost of capital and use that basically as our discount rate using a no growth formula. Okay, there's a couple of inputs that we've got to put in, calculate first of all. First is basically our, we'll say return on debt, and I referred to it before, but I didn't really calculate it because I didn't have to. And then we're going to also compute a return on levered equity, and then we can do our calculations after that. Levered equity. Okay, and we've called this RL. Okay, and let's start with our return on debt first of all. Okay, the return on debt is just basically our interest rate. So basically, just to estimate, I'm going to take my interest expense, which was one of the initial inputs into this worksheet. Okay, I'll insert a row here. And I'm just to divide by my long-term debt. Now, chances are there's other interest-bearing obligations that you have there. But we'll keep it simple now. So we'll just take it in because you have pensions and everything else. We'll just take the interest expense, which I'd actually put in here as one of the initial inputs right there, and divide that by my long-term debt. And you could obviously look in all the footnotes to see where your interest is really coming from. I'll just make the assumption now that it's coming from the long-term debt. So long-term debt was 59,578, which is the number I've been using throughout. Okay, so if we take 2591 divided by 59, 7.7, about 4%. Let's see what percent that we get here really. Format cells, and we'll just use a number here, and we'll take this out. So about 4.4%, more or less. Okay, and then we've got return on levered equity here. Okay, and the return on levered equity, it's a very important number, and it's related to, as you may have guessed, the return on unlevered equity. Okay, now going back to the original concept, the return on unlevered equity would be make the assumption that you have a company without debt. If you took the same company with debt and kept adding more debt, the return on levered equity goes up. And that's because the risk for a stock in a company that has a lot of debt is greater than the risk in a company, in a similar company which has no debt, is all equity financed. Okay, that's the old theory anyway, and it makes intuitive sense, both for financial leverage reasons and other reasons, credit risk and all that. But mainly for financial leverage, it increases the volatility of your earnings. Anyway, so the base number here is going to be the return on unlevered equity. So we're going to start by assuming the base number for this is the return on a firm without debt. Then we're going to add to that the product of three numbers. One is 1 minus the tax rate, because remember that you can deduct interest. The more debt you have, you can deduct the interest on that. So that's sort of the tax effect right there. Okay, and then we'll take the debt to equity ratio, and this is why I calculated these two numbers up here. Your 12% debt, 88% equity. So we're going to divide the debt in percentage debt into percentage equity to get a debt to equity ratio. The higher that number, the higher your is going to be your required return on levered equity. And finally, the final number is sort of a premium in a sense, but it is going to be the difference between the return on unlevered equity minus the return on debt. Okay, it's sort of a premium of risk on just a generic premium risk on stocks versus debt. Okay, so the return on unlevered equity is equal to, we already calculated this up here. Return on levered equity, 8.5% more or less. 1 minus the tax rate is 1 minus, we had the tax rate somewhere up here. That's 16.51%. The debt to equity ratio is, and that's why I like doing the weighted average, the adjusted present value approach first, just to estimate this number here. You could estimate using market parameters, obviously, in your life. And then finally, the return on unlevered equity minus the return on debt. So the return on unlevered equity was up here, 8%, minus the return on debt, we know was about 4% here. Okay, so the return on unlevered equity, and we'll put it right here. We'll put it right here. The result of the return on levered equity, we'll put it right down here. And it's going to be, I'm not going to write the equation down because I'll upload the sheet with the assignment. It's going to be the return on unlevered equity plus the product of marginal tax rate times the debt to equity ratio times sort of this return premium you have here. Okay, so that should give you 8 and close to 9%. Close to 9%. Now, one interesting thing to note is that this is your anchor number here. That's your base return on equity. If your firm has no debt, you are in this position right here, and the more debt you have, the more you become like this firm here. You've already seen in some of the companies you've looked at, they have negative retained earnings, so they have a ton of debt. So those would be risky companies from a stockholder perspective even. Okay, so we'll go back to this, and the reason I want to show you that is, let's say we change the debt to equity ratio to 0, meaning you have no debt. If you do that, then the return on levered equity is equal to the return on unlevered equity. So the more debt you have, sort of you could graph this as a line. The more debt you have, the greater will be your return on levered equity. Okay, it's a continuum. The more it's the risk. The more debt you have, the riskier you get. Okay, so we have our two base returns. One is the return on debt, which is that number right there. I'll put it in red here. And then one is the return on levered equity, which is that number right there. Okay, now we can compute our weighted average cost of capital. We're going to compute weighted average cost of debt. I'll just call it weighted cost of debt. And then we can have cost of equity, the weighted cost of equity right here. So the weighted cost of debt is just going to be the percentage of it's going to be the product of three things. First of all, it's going to be the percentage of your capital that is debt, which is that 12% up here. That's why I calculated these two numbers right here. It's going to be the percentage of your capital that is debt, right? That PD right there. And you're going to multiply that because you can deduct it. We're going to take the tax effect into account. So 1 minus your tax rate. And then finally, we're going to take it times the interest rate, basically. Okay, so, and then we'll put the weighted cost of debt, we'll put it out here, and then we'll sum the two different types of capital equity up. So we're going to start with the percentage of your the percentage of, we do that here, the percentage of your capital that consists of debt, which is adamant right there, 1 minus the tax rate, which you already have here. So we'll take that times 1 minus the tax rate, okay, and then the return on debt, we already calculated the return on debt as that number there. So on a weighted average basis, and it's just going to be the product of the percentage of debt times your tax effect times your the return on debt. So C, B, C, D, there you go. So your weighted average cost of debt is less than 1%. And that's all a function of a low interest rate, but also because you're only 12% of your capital consists of debt. Let's go ahead and just, well, I'll pretty it up later. I'll put the video up and pretty it up later. Okay, this is going to be a similar calculation. We're going to take the percentage of your capital that is equity. This is your weighted average cost of equity. So we're going to take the percentage of capital that is equity, and we're going to multiply that times the return on levered equity. And it makes sense that we're going to use levered equity because by definition, we're using a weighted average cost of capital, which includes all types of capital of a firm. Okay, so the percentage of your capital is equity is almost 88%. The percentage of your levered cost of equity is that number right there. Okay, and we're just going to multiply it to it. Now, there's no tax effect because dividends are not tax deductible. Okay, so there we get about 7% there, or close to 8%. Okay, so your weighted average cost of capital is the sum of your weighted average cost of equity. I'll even put it's the sum of your weighted average cost of, here, the sum of your weighted average cost of debt plus your weighted average cost of equity. So we've got about 8.3%, which is close to, let's see here, we have lower than the return on unlevered equity. All right, and that's because of the weight. Okay, because of the small weight on debt right here, only 12%. Okay, let's see how this works out now. Okay, now we're ready to use this number right here to calculate the value of the firm. Now we're going to go the same sort of steps that we used before. We're going to skip one of the steps because it's already incorporated into that interest rate. Okay, so we're going to calculate the value of the firm, of the operating assets, basically, of the firm. Then we're going to take out debt, and then we're going to put in the non-operating working capital, like the excess cash and all that, and then we'll have our value of equity. Okay, and there's something I do want to point out in these two calculations here. Okay, so let's start with, we'll just call it value. What I want to do is actually go up here and go up here to that last one, and the value of the operating assets of a leveraged firm. This number that we get here should equal the number we got before. But we're just going to, we're doing it via the interest rate rather than the, adding back the tax benefit on the interest rate. Okay, so we're going to take the free cash flow to the firm that we took before. So we're going to take the free cash flow of about this is 4986.29, and we're going to divide it by the weighted average cost of capital. Okay, and if we did this right, and we'll know we'll be right on target here, is we get 492,95152, and we're calling that, we're saying that that number there is the value of the operating assets of a levered firm, theoretically speaking, and it should be equal to, there it is, 492,591.52. So you get the same base number, base valuation. Now we just add in some net operating, in some non-operating assets, take out some um, debt, and we're going to have the same number, obviously. But you've got to compare how we got there. Up here, we took a firm that we assumed was unlevered. So basically, we took this firm, we added the value of the tax shield. So we took the value of an unlevered firm, added the value of the tax shield, and came up with the value of a levered firm based on the theory that the only value of debt is the value of the tax shield. And we got the same number, 491, 492, whatever it is. We got the same number down here. But what we're able to do down here is we took the free cash flow of the firm and we divided by an interest rate that considers that if you work through all this stuff, it's very easy algebra basically. We adjusted it rather than adding back the value of the tax shield directly for interest, the interest worth of the tax shield. We worked it into the interest rate itself. So that's how we got the number. It's a more direct calculation sense. And, the WACC approach is used widely. Everybody uses WACC approach. Okay, so all we've got to do now, and I'm going to go ahead and put an upper line on this just to separate out the WACC. Okay, and then, so we've got the same number. We've got the value of a levered firm, the operating asset of a levered firm. We can do whatever we want. Now we're going to add in I'll use the same title. I'm just going to use the same title as I did up here. We'll add in the non-operating assets. All right, we'll take out the debt later. We'll add in the non-operating assets, one which is the cash, and one which is the short-term investments. One which is the short-term investments right there. Okay, and so we're starting with the same number. We're going to add the same non-operating assets and take out the same and add in the same short-term investments. So we'll wind up with the same result. But the major difference is how you calculate the value of the operating assets. There's your short-term investments. Okay. Why did that? Never touched that cell. The number. Good. Okay. And okay, so we'll add in our non-operating assets, which is just the cash that's sitting around, and then we'll subtract out the value of the long-term debt. That would happen. Okay, and so we'll just subtract the value of the long-term debt, which I've been doing all along. It's 59 something. Here it is right here. Okay, and so we should get the same basic value of 56,900. Let's make sure we do. There it is, 56,900. Okay, and we'll just divide by the shares, number of shares, and obviously we're going to get the same result. So we'll get, this is a subtotal. Okay, and then we'll divide by the number of shares. Okay, so these are shares. see right here is your number of shares. Now that's not currency, that's shares. That's just a number. Okay, and I'll put shares here. So, and obviously, I want to emphasize that both numbers were no growth. Okay, so the number you get is equal to that, the value of the equity, because we value the operating assets, we added non-operating assets, which are the fluff cash and just the short-term investments playing around with. Took out now this is the book value of debt. You have to look at the notes of the financial statements to get the full detail of that, because there's always changing gap on that. But $74.89. So we got the same number using both methods, which is not surprising. The major difference, $74.89, the major difference is in the concept. In the adjusted present value concept, we take the value of an unlevered firm, add the value of the tax shield, then we get $492 in operating assets. Then we add non-operating assets, take out the debt. You get theoretically the value of equity of a levered firm. Okay, and let's see, maybe I can put this title down here. Okay, so this title would be equal to that title right here, the value of equity of a levered firm. They're the same numbers. So you're going to get the value of equity of a levered firm divided by shares, and you get value per share, no growth. Okay, now they're done two different ways. There's actually a third way too, called the flow to equity approach, which I don't use. It's very direct, but I'm always suspicious of when you get too much debt. It makes your stock returns more volatile and everything else. I just don't like it. I like to take things apart and put them back together again. Just my nature. Okay, but I like to at least use these first two methods. The WACC approach is the best one. And you could actually, for this market value balance sheet, you could actually use market values. And some of those market values for especially like debt might be in some of the footnotes. It depends what they're disclosing. But anyway, so we got $74.89. That looks like a low price. We know it's trading around 230, but we'll now add some growth. We'll do a short type evaluation to add the growth in. But we'll see if we can land a price close to what we have. Okay, but what we will consider is we'll be using the weighted average cost of capital as our discount rate for the super growth period. We'll use a short super growth type valuation to keep this manageable. But we're going to use the weighted average cost of capital as our super growth rate. And I might be interested to play around with the percentage a little bit. Okay, so anyway, so let's bottom border this thing. Okay, and we'll add growth, and I'll start a new video here. Okay, so I'll cut this video off, and then we'll start the new video coming in.